Some ETFs promise high income, others promise growth, but every once in a while a fund comes along that tries to do both at the same time. That's where AIPI gets interesting. It builds around one of the most explosive sectors in the market right now, artificial intelligence. But instead of just chasing growth, it also tries to generate income along the way. The question is simple: what actually happens when you put that strategy to the test? Because high yield always sounds good on paper, but the real story shows up in the data. So stay tuned. Welcome back to Simply Money. Today we're putting AIPI through a full backtest to see how this AI-focused income strategy actually performs over time. AIPI is designed to give investors exposures to companies connected to artificial intelligence. But it doesn't just hold the stocks and wait for growth. Instead, it uses an options-based income strategy layered on top of those holdings to generate additional cash flow. That means investors are getting exposure to companies tied to AI innovation while also targeting income distributions from the option strategy. Now, strategies like this can look very attractive because they combine two things investors love: technology exposure and high income potential. But the real question is how those strategies behave when the markets move. What happens to the income? What happens to the portfolio value? And how does the total return actually play out over time? So instead of guessing, we're going to run the numbers. We're going to look at a portfolio value, income generated, reinvestment scenarios, and total return. So you can see exactly what happens when the strategy plays out over time. Let's jump into this backtest. For those that are new to the channel, thank you for joining us. What we're doing here is we do a hypothetical backtest. We have a $525,000 income portfolio that was asked months ago, what would happen if you had invested it all in a particular fund? So people started wanting to see that in other funds, and now AIPI is one that people have requested. They want to see what would happen if we did this. Now, this is not financial advice. This is for informational and educational purposes only. I do not recommend investing all in on any fund, and please do your own due diligence when making financial decisions. All right, so with this fund, we're looking at around July 29th, 2024 of inception. The share price was $49.85. This is a monthly paying fund, so the distributions are paid out once a month. Again, this is AIPI. With a $525,000 portfolio, we would have been able to buy 10,532 shares. And we're going to look at a couple different scenarios and see how it's functioned. This is designed to create income, but we also obviously want return. We want total return. That's what we're after. The question we're going to look at is, does the income being paid out actually benefit, or is it better to drip? And if you're dripping, then why do we own this if we're not going to eventually take the income, because that is what it is for? If we're going to just perpetually drip, we should probably be in a growth fund or the underlying funds of this. This is looking at things like Palantir, NVIDIA, and again, AI stocks. If you're looking for just reinvesting for growth, you're better off usually going with the underlying funds. We're going to look at those. We're going to look at scenarios of dripping 100%, 50%, and not dripping at all, see what kind of income it would produce, see how our portfolio maintained its balance or if it grew. We'll look at all of that. Coming down column A, we have the dates each month. We have the share price, what it was at that time. And then in column C, we have how much the distribution was per share. We'll start just by looking at the share price. We can see, again, start at $49.85, got up to about $50. The April tariffs this past year, about a year ago, we're looking at got down to $39.88, and then it bounced back up a little bit. But as of the end of February 2026, right now sitting at $35.50. So it has had a drop of negative 28% on the share price. That is something to keep an eye on as we're looking at that. Now, if it's paying enough to where that offsets that, it's not a big deal. But if the distribution isn't covering the amount that you're losing and some, then you're not really getting income. So we want to keep an eye on that. So let's look over here, column C. We can see that the distribution started out at $1.47. It bounced right around that. It didn't fluctuate a lot. Come the April tariffs, it went down to $1.10 and it stayed down there for a little bit. It bounced back up into $1.27 range and then back down a little bit. And now this latest one in February down to $1.03. Now, over the course of this time, we're looking at about $1.30 average per month, but you can see it has been dropping as that share price has been dropping. If we were to take this, let's look at July 29th, 2024, the first payment of $1.47 per share. We had our 10,532 shares. That would have paid us out $15,000. And with that, in this full drip scenario, we're buying more shares. And so now we have 10,644 shares. And in column I here, you can see that your balance would have gone up to 540,000. It started out pretty well, and we're going to go down and see how this is doing in a full drip mode. As we move down, you can see, again, the distribution went up because you're adding more shares as you're buying more, and the distribution was going up a little bit and maintaining around that same amount. So it was gaining total payout. But when that started dropping, the distribution, you can see the payout started dropping. Now we got down to 15,000. But then as it comes back up, that distribution, because you're adding so many more shares, you're getting 18,000, 19,000. Then we get up to 21,000. And this is what I want you to see. Even though the payment per share is down to $1.03, because you're dripping, your payment, the distribution amount to you, is based on this 18,320 shares. You got $19,000. Even though you're down 44 cents per share on distribution, you're up about $4,000, $3,500 for the month on the distribution. And that's where dripping can pay off. If you do that for a while and increase the amount that you're getting paid, and then maybe you could go to a 50-50 or 20-80 drip, whatever works for you with each of these individual funds, and you'd want to look at that and see what works out. But that's what a lot of people will do. They'll buy and then they'll drip for a while to build up their share quantity and then collect these higher amounts down the road. And so you have to do whatever fits your goals and your financial needs at the time. Moving over here to column E, this is our 50-50 drip. As you can see, this is 50% of what the full drip is. So this doesn't represent the full amount. This represents half of it. So you're getting this amount twice. The first time, we're going to say you get $7,792, and you're buying more shares. You're dripping 50%. You're reinvesting half of the amount, which is almost $8,000 here, and that brings your share total up to $10,688. But you also get $7,792 in cash that you can use for your expenses. For some people, they're like, I'm going to make an investment in this. I'm going to drip 50% and I'm going to keep 50% to drive some income. By doing that, you're still adding some shares and building up your quantities. And as we come down, you can see that it went up a little bit, then dropped as the share price dropped and the distribution dropped. Then it started going back up a little bit, but you're basically ending just slightly below where you started on this lowest payment, but not too far off. It's been very consistent right around the 77, got up to 8,500, then went down to 6,600, and now it's back up again to 8,000, 7,000 here. So it's been pretty consistent. By doing that, you've added 3,590 shares. Versus by doing a full drip, you've added 8,324 shares. So you haven't added as many shares, but you can see that you have increased your share quantity. Now I want to look over here to column I. With the full drip, your share value, your portfolio balance went up $144,000. Now it had peaked up here about $765,000, but because the share price, the beginning of 2026, has begun to drop, that has come down some. So there's something to keep an eye on if this will recover some. Obviously that would go back up. but you've been able to add a whole lot of shares during this process. With the 50/50, your portfolio is down about 23,000. You're in the green most of the time. There was a few times right before the tariffs and during the tariffs it dropped slightly, regained, and just recently it's dropped back down. But over the course of this time, you've received $157,000 in distributions, and you've only lost about $23,000 in unrealized gains in the short time frame. It's not a lot, but something to keep an eye on as well. Now with the zero drip, we're taking the full distribution and we're not reinvesting anything. As you can see here, you get that first payment of $15,565. You're taking that as income, so you're not adding any new shares. And with that, you're going to see your distribution dropping and coming down here. Now you're only getting $10,000 of distribution because you still only have that 10,532 shares, and the distribution amount per share has gone down 44 cents. But over the course of this time, you've received $275,000 of income. But this is where you have to look. If you come over here to your portfolio balance, you're down $151,000. That is one of those funds that in the short time frame we're looking at, again, we don't have a huge time frame. You'll have to look at that and watch it over time. But in the short time frame, we have not seen that maintained. So you would probably want to drip some to at least maintain this portfolio balance. That's in my opinion. But for some people, they're just taking the income and they'll let that ride down. They'll recoup what they made, and then whatever after they're looking at, that is gain. And everyone has a different approach how they do. Now, coming down here to the total returns, you see with the full drip, our portfolio balance is up 144,000. That's about a 27% gain on that. The 50/50, it's down 23,000, but you received 157,000 in cash. You have 133,000, almost $134,000 of total gain, and that's about a 25%, 25.5% return, total return. Now with the no drip, you lost $151,000 in unrealized gains in your portfolio balance, but you received $275,000 in cash. That brings your total return to $124,000, or just under 24%. Total return, they've all done well. You just have to monitor that and see which method you want to use and which one works into your strategy. For some people, they're taking this full income and they're using some of it. Maybe they're using it to reinvest into other positions, maybe growth positions or a different position they want to build up. Everyone has a different approach. Others are just building up, doing a full drip and building up the share quantity that they own. If you like this sheet, you can get a copy of it down in the description below at the Buy Me a Coffee. It is the AIPI drip sheet. All our sheets are available there. And you can put in the date that you buy into it, the amount that you want to look at and backtest how it would have done, and go from there. And then over here, we have these two calculators. This one here, you can put in a percentage. Let's say like I did here, I put 55% drip and I'm going to keep 45%. And that gets us to where we're just down about $8,000 on our balance. Again, you could put that to 60%. We'll do that real quick. So if we go 60%, put that at 60%, means you're keeping 40%. And we've maintained our balance. So you can play with it and say, okay, with this, in this scenario, under these data points, I would have had to reinvest 60% to maintain my balance. But by doing that, my balance has stayed pretty much consistent, and I've received $129,000 of income. You can see here about $6,000, $6,500 per month. And it's a way to play with that. Or if you want to come over here, you can put a dollar amount in, and I put here $6,000. I'm going to take out $6,000 a month every month. It's not going to be adjusted or anything each month. Whatever is left is reinvested and buys more shares. As you come down here, you can see that you're getting your $6,000, and over here in this column S, you're seeing all the money that's going back into reinvestment. At the end of the time frame, you're up $47,000 and you received $156,000 in cash. Perhaps you say, I only need to supplement my income. I only want $3,000 a month. Going to reinvest everything else. So that's $3,000 coming out. More is being reinvested. So your balance is growing. Just a way of playing with this. With all these sheets, we do that for you to be able to have your control over how much you invest, when you started, and seeing the different drip scenarios for yourself. Do you own AIPI? If so, leave me a comment down below. What do you think about it? Are you bullish on it? Are you bearish on it right now? I know everything's very volatile in the market right now with everything going on in the global markets and in the world, and everything happening causes a lot of volatility. Everything's a little jumpy. What's your thought on this fund just in general? Give me your opinions down below. And if there's a fund you want to see, as always, leave that in the comments below. It helps me create videos that you want to see, that you have requested, and I appreciate that. That's it for today. Thank you for joining me, and we'll see you next time on Simply Money.